All right, let's get straight into it. These are the top growth stocks that I'm watching this week and throughout September. Amazon, Taiwan Semiconductor, NVIDIA, Adobe, e.l.f. Beauty, Celsius, Block, and Crowdstrike. For each of these stocks, I'm going to cover the bull case, the base case, the bear case, and the key numbers I'm tracking right now. Stock number one, let's talk about Amazon. Amazon is much more than online shopping now. Their core retail business is still massive, but the profit drivers today are AWS cloud computing, digital advertising, and now their push into AI hardware. AWS, or Amazon Web Services, is their cloud platform, so companies rent computing power and storage instead of buying their own servers. It's high margin and it's sticky. Add in advertising, those sponsored product listings you see when shopping, and you have another fast-growing, high-profit segment. Now they're moving into custom AI chips, and Amazon is building huge data centers for Anthropic, one of the major AI startups. These centers will use Amazon's own Trainium chips designed specifically to train large language models, and that means less reliance on NVIDIA and more control over their AI economics. So here's the bull case. AWS accelerates with AI demand, ad revenue grows double digits, retail margins improve, and the stock heads into the 200s. Here's my base case for Amazon. Cloud stabilizes in single digits, ads stay strong, and retail breaks even. The bear case would be AWS pricing pressure, regulatory issues for ads, or weak retail margins. The stock would underperform their peers. And here are some metrics to watch this week. AWS growth compared to Microsoft Azure, ad revenue momentum, and free cash flow. Basically, how much cash is left after all expenses and investments. Let's talk about stock number two, Taiwan Semiconductor, or TSM. Taiwan Semiconductor is the world's most advanced semiconductor manufacturer. They don't design chips, they fabricate them for clients like NVIDIA, AMD, Apple, and Amazon. Two terms really matter here. Fab utilization rate simply means how busy their factories are, so the closer to 100%, the better. And when I mentioned 3 nm ramp, that refers to their rollout of a cutting-edge chip manufacturing process. The smaller the nm or nanometer number usually means faster, more efficient chips. So why does this matter? If AI demand keeps fab running full and TSMC earns steady, predictable revenue, then the bull case would be AI demand fills fabs, the 3 nanometer rollout succeeds, free cash flow rises, and the stock breaks prior highs. The base case would just be steady smartphone and PC demand, and balance that with CapEx, their massive factory spending. So the stock would consolidate but hold strong. The bear case here would be overcapacity, so smartphone demand drops or geopolitical tensions hurt confidence. So the metrics this week is factory utilization, progress on 3 nm chips, and free cash flow after CapEx. Let's jump into stock number three, NVIDIA. NVIDIA is the leader in AI chips, so their GPUs power most AI training workloads. Right now, demand outstrips supply. A key number is gross margin, the percentage of revenue left after production costs. For NVIDIA, that has climbed to above 70%, which is extraordinary for hardware. And the big question is competition. So AMD, Intel, and cloud providers like Amazon are all developing alternatives. The bull case here would be the data center revenue keeps growing, triple digits, and the margin stays high. So the ecosystem would also strengthen and the stock pushes past $1,200. The base case here, growth slows to double digits, supply balances, margins stay healthy, the stock would just consolidate but compounds gradually. The bear case would be competition from AMD or custom chips takes share, and the pricing power weakens and the stock retraces. The metrics to look out for this week are data center revenue, gross margin, and supply commentary. Let's talk about stock number four, Adobe. Adobe is a software giant behind Photoshop, Acrobat, and Creative Cloud. Their business is mostly subscription-based, which makes revenue very predictable. Now they're adding AI tools like Firefly, which let users generate images and designs faster. If adoption is strong, it could raise the average revenue per user, and the bull case here would be Firefly drives upsells, revenue growth returns to double digits, margins expand, and the stock pushes towards $700. The base case here is growth stays 8 to 10%, margins steady, and the stock just tracks with their earnings. The bear case would be competition or weak AI adoption slows growth, and the stock trades closer to $400. Here are the metrics to track: subscription revenue growth, AI adoption rates, and free cash flow margin, and a key measure of profitability after everything is paid for. That's it for Adobe. Let's talk about stock number five, e.l.f. Beauty. e.l.f. is one of the fastest growing consumer companies. They win by offering affordable cosmetics that resonate with young younger buyers while also taking more shelf space in big retailers like Target and Walmart. They've already grown massively in the United States. Now the focus is international expansion. The bull case here is revenue keeps growing above 20% a year, margins remain high, global sales ramp, and the stock compounds higher. The base case is growth slows to single digits, margins stable, and stocks track with earnings and growth. The bear case would be competition increases, promotions cut into margins, and the stock underperforms. The metrics I'm looking at is retail expansion pace, growth margins, and percentage of sale from outside the United States. That's it for Elf Beauty. Let's look at stock number 6, Celsius Holdings, or CELH. Celsius is in the beverage space, competing directly with energy drink giants. Their growth has been explosive thanks to distribution partners and strong brand positioning. For beginners, distribution expansion just means getting more shelf space, more gas stations, more grocery chains, more gyms. That's the lifeblood of beverage growth. So the bull case here would be 25% plus revenue growth continues, margins expand, and global reach improves. The stock would compound rapidly, essentially. The base case here is growth slows to the mid-teens, margins stable, and stock tracks earnings. And the bear case here is competitors fight back hard, so growth might slow below 10% and valuation compresses. The metrics I'm looking at here is distribution wins, margin trends, and sequential revenue growth. That's it for Celsius. Let's look at stock number 7, which is Block. Block, formerly Square, is a fintech company. They operate payment systems for merchants and the Cash App for consumers. Two terms to know here are total payment volume, or TPV. It's the dollar value of all transactions processed, and the take rate is the cut that Block earns from that volume. The story now is about profitability. They're cutting costs, they're driving efficiency, and they're leaning more into software. The bull case is TPV grows steadily, take rates expand, their free cash flow would climb, and the stock heads towards $100. The base case here would be moderate growth, margin improves slowly, and the stock consolidates. Bear case here would be consumer spending weakens, Cash App slows, and profitability misses. What are some important metrics to keep in mind here? Payment volume, take rates, and free cash flow guidance. All right, let's talk about stock number 8. It's gonna be Crowdstrike, or CRWD. Crowdstrike is a leader in cybersecurity. Their Falcon platform protects devices and data for enterprises. One important metric is annual recurring revenue, or ARR, basically the value of subscription contracts signed. And the higher the ARR growth, the healthier the business. Crowdstrike is expanding into identity and cloud security, which makes the platform stickier and increases deal size. The bull case here is ARR growth stays above 25%. The margins would expand and free cash flow grows fast, and then the stock would re-rate higher. The base case is growth slows to the mid-teens and then margins improve and the stock consolidates. Bear case here would be longer sales cycles, pricing competition, or security breach, and then the stock would retrace. The metrics to look out for would be ARR growth, new large customers, and operating margins. Now, before we wrap up, let's talk about something that is just as important as picking the right stock: risk management and position sizing. Here's the truth. Even the best stock pickers lose money if they allocate too heavily into a single name. A disciplined investor limits any single position to a reasonable percentage of their portfolio, and it's often 5 to 10% or less. Why does that matter? Let's take an example. If you put 30% of your portfolio into one stock and it drops by 20%, your entire portfolio takes a 6% hit. But if that same stock was only 8% of your portfolio, the overall impact is closer to 1.5%. That's the difference between staying calm and panicking. The goal isn't to avoid risk, it's to control risk so you can survive downturns and stay invested long enough to let compounding do its work. Remember, wealth is built not just by finding winners, but by protecting yourself when things don't go your way. The second point I really want to leave with you is this: index funds are the foundation of a balanced portfolio. It's easy to get excited about growth stocks like Amazon, NVIDIA, Celsius, and others we talked about today, but no matter how promising they look, the individual stocks will always carry company-specific risks. Index funds like those tracking the S&P 500 spread your investment across hundreds of companies, and that diversification protects you from being overly exposed to any single failure. Historically, broad market index funds have delivered 8 to 10% annualized returns over long periods, and that's the benchmark that most investors should aim to beat. It's also the safety net you should lean on if you want steady wealth growth. So here's the balance. Keep the majority of your portfolio in broad index funds for stability, then use a smaller portion to invest in individual growth stocks you researched and you believe in. That way you capture potential upside without risking everything in just one or two companies. The bottom line here is don't go too hard on individual stocks and use them to enhance your portfolio, not replace the solid foundation that index funds provide. So here's your watch list. Amazon, Taiwan Semiconductor, NVIDIA, Adobe, Elf Beauty, Celsius, Block, and Crowdstrike. That's it for today's breakdown of the top growth stocks to watch in September. We covered some of the strongest names in tech, consumer, fintech, and cybersecurity, but remember that building wealth isn't just about chasing the next hot stock, it's about discipline, balance, and playing the long game. Always manage your risk, keep individual positions sized properly, and make sure that the foundation of your portfolio is built on index funds. Those give you broad, steady exposure to the market, while your stock picks add targeted upside. Don't overload on any one company. Let diversification do its job. If you apply this approach consistently, you'll be able to capture growth opportunities without putting your financial future at risk. I'm Chris. Thanks for spending your time with me today. Make sure to hit that like button and subscribe if you haven't already, and I'll see you in the next one.